On behalf of Pitcher Partners, Macmillan Clark, and the Melbourne and Sydney Compliance Committee groups, thank you for joining our Compliance Forum webinar. As we gather for this virtual event and are physically dispersed, let's recognise the various traditional lands on which we do our business today. I wish to acknowledge the traditional custodians of the land we work and live on and pay respect to the past, present, and emerging generations. I'm Emma Donoghue, a partner in Macmillan Clark's Funds Management team, and I'm pleased to welcome you to the Compliance Forum webinar today. We have over 420 registrations today, so it's great to see this forum is proving more popular than ever. As the corporate regulators rethink their strategic priorities in the current environment, there's a raft of new regulatory and compliance issues ahead for the financial services sector. In today's webinar, I will kick off with an essential update for fund managers, including what you need to know about Treasury's proposed review of the regulatory framework for managed investment schemes and new learnings on the design and distribution obligations. Following myself, Selena Nutley will take a close look at how the financial regulators are clamping down on greenwashing and what you need to know so you don't cross the line. Selena leads Macmillan Clark's litigation team. And finally, Alexis Kokonos will analyse the impacts of current and topical tax issues for managed funds. Alexis is a director of business tax at Pitcher Partners. We've deliberately kept the format pretty brief today with presentations scheduled for 45 minutes so that we have time to respond to your questions at the end of the presentations. We encourage you to submit questions via the Q&A box to our presenters throughout the presentations, which we will respond to at the end. Also, we'll provide links to the presentation and recording of our webinar today over the next few days. So I'd now like to start with my presentation of a legal update for fund managers. So there are two key regulatory updates that all fund managers should be aware of, which will be the focus of my presentation today. They are Treasury's review of the regulatory framework for managed investment schemes and also ASIC's recent report on design and distribution obligations. Turning first to the review of the MIS regulatory framework, currently the information on this is quite limited. There was a brief statement in the budget where funds were allocated for the review and also a media release that was issued by Treasury. So the media release did set out the scope of the review, including that its focus will be to ensure that the MIS regulatory framework is fit for purpose. It identifies any potential gaps and also consider what enhancements can be made to reduce undue financial risk for investors. Obviously, that's an extremely broad scope, but it has been narrowed down into the following areas. The thresholds that are applicable to wholesale client test. So taxable income, the wholesale client test, as most people will be aware, is taxable income of $250,000 or $2.5 million of net assets. This test was set all the way back in 1991. Back then, the average weekly earnings were about $600. As of February 2023, average weekly earnings have increased to about $1,800. The residential property prices have also increased significantly during that time. This has led to a rise in the percentage of the population that meets the test. A recent report provided that the percentage has increased from 1.9% in 2002 to more than 16% currently. Given the rationale behind the wholesale retail client distinction is that wholesale clients do not require the same level of protection as they are better informed and better able to assess the risks involved in financial transactions, it would seem that the net test does need to be updated to ensure it remains current. The change to the test is obviously going to have a substantial impact on current wholesale fund operators, as it will reduce the potential investor base, and fund managers will need to consider if it will remain viable to limit their product offering to only wholesale clients. The other aspects of the review will be whether there are some managed investment schemes that are just inappropriate for retail investors and therefore should not be marketed or sold to them, the role and obligation of responsible entities, and whether the governance, compliance, and risk management frameworks for MIS are currently appropriate. And then the interactions between Commonwealth and state laws when regulating real estate interests by managed investment trusts. This includes the issues that arose from the failure of Sterling Income Trust. In that case, you had investors that had an interest in a managed investment scheme and also held real property leases. That product was then regulated by two different bodies, one being ASIC in relation to the Managed Investment Scheme, and the second being the WA Department of Mines, Industry Regulation and Safety. There are claims that investors did not appreciate this, and it was also part of the misunderstanding of investors on how the product was regulated. The other final two things that the review will consider is the liquidity requirements for MIS, and also whether an insolvency regime is required for MIS, given that most are structured as trusts, and there is currently no mechanism to appoint a controller over the MIS only. Rather, the controller has to be appointed over the trustee. So this type of regulation would most likely be useful and welcomed by industry, particularly for fund managers that are trustee of several different MIS. It is also consistent with the approach that was taken with the relatively new corporate collective investment vehicles, or CCIVs. Treasury is expected to release a consultation paper by mid-year on their review, and then following which it will consult with industry before reporting to government by early 2024. So with little detail released thus far, it is truly a watch this space. Moving on to an area where there is plenty of guidance and information available, design and distribution obligations. So over the last 18 months, I'm sure that we've all become familiar with the term design and distribution obligations, or DDO. I don't propose to go into any detail on DDO today, but I will give just a brief overview of what it is for those unfamiliar, and also pull out some key findings from the report recently issued by ASIC. DDO commenced in Australia on the 5th of October 2021 and is based on similar models overseas, including Europe and the UK. It applies to registered managed investment schemes that offer investment to retail clients. It does not apply to schemes that offer investment to wholesale clients only or to closed registered schemes. DDO is a bit of a step change. It's intended to help consumers obtain appropriate financial products by requiring issuers and distributors of financial products to take a consumer-centric approach to the design and distribution of their products. A key stick in ASIC's powers to ensure compliance with DDO is to issue a stop order which prevents a product being issued until ASIC's concerns with DDO compliance are addressed. No one wants to be on the receiving end of a stop order, particularly because they're all published in an ASIC media release. We've all seen them, like the one on this next slide, that was issued in March to Advance Asset Management Limited in connection with 3 of its funds. ASIC's issues with the funds of Advance Asset Management is that the TMDs were very broadly drafted and they failed to define key concepts. ASIC particularly pointed to the description of investors' risk tolerance being at the medium to higher end or higher end of the risk spectrum without any further explanation. ASIC also took issue with the distribution conditions, the reporting requirements for distributors, and the review triggers for the TMDs. The good news is that Advance was able to amend the TMDs to address ASIC's concern, and the interim stop orders were cancelled on the 30th of March 2023. If they had not, then ASIC could have issued final stop orders in connection with the funds, and Advance would no longer have been able to issue interest in those funds. Advance is not alone. Since October 2021, ASIC has issued 41 interim stop orders under DDO. Of the 41 orders issued, 33 have been lifted, either because the issuer has taken actions to address ASIC's concerns or they've withdrawn the products altogether. And there's still 8 that remain in place. Whilst ASIC's surveillance to date has largely focused on non-compliance with TMD requirements, ASIC has made it clear that it plans to look behind the curtain. That is, beyond the publicly available TMDs, and carry out surveillance work that focuses on the issuer's compliance with the reasonable steps obligation. ASIC Report 762 outlines its findings in response to its initial risk-based review of how product issuers are meeting their DDO obligations. It comes after a review of several TMDs for compliance and also reviewing the product design arrangements of 12 issuers to check how they met the reasonable steps and also review their TMDs. It found that there was significant room for improvement and has asked product issuers to lift their game. So what do you need to do to keep on ASIC's good side? Moving on, I'll consider the good practices that should be implemented across product design, the TMD, distribution and monitoring, and review. Turning first to product design, the starting point for all product issuers needs to be the consumer. ASIC expects issuers to identify the target market before they design the product and ensure that the product that they design is appropriate for the class of consumers that they've identified. ASIC also expects boards to be involved at all stages of the product cycle, beyond the product design to the adequacy of distribution arrangements and to product and distribution review and monitoring. They're further expected to stress test the expected performance of products through all stages of the economic cycle, not just when things are going good, but also look at what will happen when there's stresses within the economy. Issuers should engage with the distributors for their products from the development stage. It's not good enough to develop a product and then just go out to your distributors. You need to engage with them early so that they can assist with the identifying appropriate distribution channels and setting distribution conditions to satisfy the reasonable steps obligation. We then need to look at what the TMD actually says, because whilst ASIC will focus on what's behind the curtain, they're still going to be looking at the TMDs that are in the market, and they're still raising significant concerns. We understand that a lot of fund managers are using the Financial Services Council template TMD, and for various reasons, including sometimes it's used very inappropriately, or issuers are not turning their mind to DDO, this template has been the subject to many of ASIC's interim stop orders. ASIC has said that if using a template TMD, fund managers must customize it specifically for their product. So following extensive consultation with ASIC, version 2 of the FSC TMD template was settled late last month, and we do expect it to be issued to the public shortly. The changes made to the TMD template also reflect ASIC's comments on TMDs in its report. So when completing a TMD, especially those based on a template, I've got some tips that you need to remember. First of all, if you're using that amber rating, you must state when investors would be in the target market. It's not sufficient to just say that the investors might be within the target market. You have to provide further explanation. This has always been our approach, and we consider that the use of amber can be appropriate in certain circumstances. And it is in fact a conservative approach if amber is used instead of green. Given that it is very rare for an investment product to be capital guaranteed, FSC has actually removed this option as a consumer investment objective from the template. The allocation of consumer investment capital to a product has also come under fire from ASIC, and the new template TMD breaks this down into 5 categories rather than the 3 that were previously available. Furthermore, when considering a consumer's investment timeframe, issuers should specify a minimum investment timeframe rather than just a range. So previously, the template looked at whether the investment timeframe should be short, medium, or long. Those timeframes can still be included, but a minimum timeframe needs to be included as well. Another aspect to consider is how risk, which is the ability to bear loss, and return profile is described, and that should also be included in the TMD. The FSC has changed their template, so it will include an extremely high category, and the focus is on comprehensive risk assessment that considers the overall risk of significant or total capital loss. This is the magnitude of a potential loss in any year, in addition to an assessment of the number of years of loss over a 20-year period, which is the focus of the SRM measure of risk. Consumers need to access their capital, particularly investments with limited liquidity, and how this feature is presented in TMDs has been a focus of ASIC in the interim stop orders they have issued to date. In the FSC template, this attribute was previously referred to as the need to withdraw money. It is now being changed to focus on the time from when a consumer makes a withdrawal request. It has also been broadened to incorporate an on-off market sales or transfers. Finally, in the TMD, you need to consider the distribution conditions. This has been a focus of ASIC as well in their stop orders. So to have, and there's, especially when there's no distribution conditions, to include that, it would mean that the product is available for all consumers and appropriate for all consumers. So that's unlikely to apply to very many products. So an example of a distribution condition is that retail investors are not able to directly invest in a fund, but rather need to come through an advisor that has given them personal advice. Then looking towards the distribution and oversight and the monitoring and review arrangements for TMD, beyond TMDs. So ASIC expects issuers to have background policies that they follow. ASIC have said this is what they will focus on in their next DDO surveillance and enforcement activity. It will include things such as monitoring distribution strategy and sales processes, overseeing third-party distributors, setting specific and detailed review triggers, and having a process to identify when those review triggers occur, actually conducting the reviews when they're required, and having ongoing board involvement through all strategies of potential product cycle. This is all critically important, as ASIC has said they will take enforcement action if necessary. This was demonstrated in ASIC's civil penalty proceedings brought against Firstmac Limited in respect of an MAS, and also American Express in respect of a credit product. This is such a big change in regulatory approach, and as I've demonstrated today, there are a lot of factors that need to be considered. To assist you with compliance with DDO, we've created a DDO health check. This is a checklist that goes through the top factors that you need to consider when you're looking at your DDO overall policy. We can provide a link to this when we send out the materials for this presentation. So now that I've covered off on the review of MIS regulatory framework and the key focus areas for DDO, I would now like to hand over to Selena, who will be taking you through another current focus area for ASIC, greenwashing. Thanks, Selena.
So I lead McMahon Clark's litigation team. I have a particular specialty in funds management related litigation, but we have an early interventionist strategy. So I try to do myself out of a job wherever possible by providing guidance to clients on issues such as greenwashing and how to prevent them in the first place coming into contact with the regulator. So this is a really topical conversation at the moment. So moving on to our next slide, this is where we're going to go briefly with the presentation today. So I should say firstly, there's a lot of content on my slides. My marketing manager hates the amount of content that I put, but the intention is that this can be a bit of a reference for you if you want to look at the presentation later on. So some content we will touch on really briefly and some we may not address at all. So the overview of where we're going, we'll talk about what greenwashing is, why it's become so topical, sources of the obligations, consequences, and then the more interesting stuff, the less dry examples of recent regulator conduct, and also tips and traps how to avoid. So moving on, what is greenwashing? Well, essentially, it's a practice of misrepresenting the extent to which a financial product or investment strategy is environmentally friendly, sustainable, or ethical. Can take a number of examples, and I've set some out there, but most commonly it's intentionally or negligently exaggerating your environmental credentials, making claims that are unsubstantiated in order to sell a product or a service, or making unreasonable or unrealistic commitments to things like net zero emissions or climate targets. Moving on to the next slides, we can see there's an extract there from what ASIC thinks the danger of greenwashing is, and that is that it distorts the relevant information that current or prospective investors might require in order to make informed investment decisions. There's also a view that greenwashing has a propensity to distort the marketplace, because if you underprice the actual cost of green production, it's of a detriment to those businesses who truly do engage in environmental sustainability, so it can be a disincentive to them investing in sustainability. Why is it so topical? Over to the next slide. If we think about the global market for ESG investing, I mean, clearly there is more focus than there ever has been on the environment, on sustainability. So the global market accounts for $53 trillion. In Australia, we're a very small portion of that, 1.54 trillion. But that's against the background of a global study which said something like 40% of claims that companies make might actually be false. So on the one hand, we have potential false claims, but as is seen in the recent ASIC survey, 73% of the people who invested in shares in the last 12 months declined to do that because of their poor environmental record. We now have this concept called green hushing, which we'll talk about a little bit later in the presentation, but it's leading to companies adopting a, well, we'll just say nothing policy. And I think what it comes down to really is with greenwashing, there is no way for companies to really readily identify or verify the accuracy of the information about environmental credentials. So they simply must trust the claims that are being made by businesses, which means that it is all the more important that there's a robust framework for preventing greenwashing. So moving on to our next slide. Just quickly, who's watching? Well, there's the obvious ones at the top. The regulators, ASIC and the ACCC. Investors, not just from the perspective of will they invest, but will they continue their investment? Will they take action if they feel that that investment is not consistent with what they expected? And lastly, we haven't seen a lot of class actions lately. There was maybe the VW emissions class action, but it seems inevitable that class action funders and firms will be looking at greenwashing because of the sheer number of people that might be impacted based on the representations and the investments. So now that we've got some context, let's talk quickly about the drier legal stuff, the sources of obligations. Largely it's statute based, and what it boils down to is you can't mislead and deceive people, and that extends equally to claims about environmental issues. So each of the ASIC Act, the Competition and Consumer Act, which contains the Australian Consumer Law, and the Corporations Act all have particular provisions that deal with that. There's also common law and fiduciary obligations, which we won't talk much about, but just remember that it is essentially at its heart misleading and deceptive conduct. So if we move over to our next slide to talk quickly about the possible consequences before we start to talk through some examples. Well, as we're going to see, action by ASIC or the ACCC is probably the biggest or the most severe consequence that we might commonly think of. There are very large penalties, potential penalties, which I've set out there. We certainly haven't seen anything of that magnitude yet, but it's possible. There's the possibility of restrictions on licenses, claims by investors for damages, adverse publicity, media coverage. You know, there is an ASIC release that goes out with every single infringement notice or regulatory action that they've taken. And then the one that we don't think about so commonly, but it's a real practical consequence, is insurance issues. So if you have a poor track record for claims, or the industry does, then it makes it more difficult and more expensive to obtain insurance. So to the extent that there is a real industry issue with greenwashing, which leads to more claims and more activities from the regulators, it's likely to flow through further with insurance issues. So if we start to talk about some examples, the first one, this is a federal court claim by the Australasian Centre for Corporate Responsibility against Santos. So ACCR is a shareholder activist group. Essentially what they do is they acquire shares in particular sector organisations, a lot in the fossil fuel style industry, so that they can raise issues from the inside. It gives them different rights than if they were sitting externally and trying to hold these companies to account. So they allege that Santos contravened the Corps Act and the Consumer Law by claiming that natural gas was a clean fuel which produces clean energy. Their argument as to why that is misleading is that scientific evidence is that natural gas contributes to climate change and global warming, and therefore can't truly be classified as green. Separately, the ACCR also says that Santos made representations that it had a clear plan to achieve net zero emissions by 2040 when they allege it actually didn't. The focus of the trial is going to be on what does clean mean? So it's one of those words that takes its meaning from its context, but it's a little bit vague and undefined. So we will see, I think, a lot of useful commentary if this matter goes to judgment as to what the meaning of the word clean can mean, at least in this context. And it's one of the world's first challenges to the veracity of a company's net zero target. So it is quite widely watched, this litigation. And now we move across to talk about ASIC intervention. ASIC has been very clear that it is an enforcement focus for 2023. And in fact, their surveillance has been ongoing for quite some time. So back in June last year, ASIC issued some guidance. They issued Info Sheet 271, which talks about how to avoid greenwashing. And they gave a little bit of time for that to hit the market. And then in October 2022, they started issuing infringement notices and fines on the basis of surveillance they had carried out. That surveillance currently focuses on retail funds, but we can't assume that wholesale funds are safe from scrutiny, because ASIC has been clear that it is increasingly focusing on a cohort of investors they call unsophisticated wholesale investors. So people who currently meet the wholesale investor test because of their asset holding, but actually have very little exposure or understanding about investing. Joe Longo gave a speech a couple of days ago, and he talked about these infringement notices and the corrective actions they'd secured. And he said, well, while I can't talk about what's in progress, I can say that we have a lot more surveillance and a lot more activity to come. So what we're seeing now certainly isn't the end of ASIC's monitoring. So moving over to the next slide, we'll see ASIC's intervention. This comes from a report released a couple of weeks ago. They found they found 4 real themes. So statements about net zero, the use of terms such as carbon neutral, green or clean, funds labelling practices, and also the scope of an application of investment exclusions and screens. So what companies are saying that they won't invest in, or sorry, what products funds won't invest in versus what they actually are investing in. So if we move across to the next slide, we'll see the first of the examples. Now, my brain as a lawyer, I got into law because it had very little diagrams. So my brain doesn't process this diagram all that well. But what it's supposed to convey is that the Lesedi power station, which Tulu Energy were developing, would be carbon neutral via sequestration from the outset. Unfortunately, what ASIC's position is that Tulu hadn't actually undertaken any modelling on the emissions the project was going to generate, the offset that would be required, whether it was feasible to use carbon sequestration as an offset, and whether they could even obtain the carbon credits or the offsets. So according to ASIC, there was a lot of very bold headline claims that were made, but no reasonable basis for making them. Unsurprisingly, in those circumstances, ASIC issued an infringement notice. And I should just briefly remark, with infringement notices, paying them isn't an admission of liability as such. So none of these companies that we talk about are considered to have admitted that they have engaged in this misconduct. It's just a way to avoid further regulatory action. So we move on to the next example, and that's Vanguard Investments. So Vanguard back in 2016 had launched a product, and in the PDS they said that the product was would track the MSCI index. Also in the PDS they said that that index excluded securities involved in the production, manufacturing and the sales of tobacco. Unfortunately, that was inaccurate because the index does include securities involved in the sales of tobacco. So when that came to ASIC's attention, there was an infringement notice that was issued, totaling $40,000. If we move over to the next slide, you'll see the inevitable FinReview article. So I've taken a screenshot of one of the articles, but there's a lot of coverage in the FinReview around greenwashing and ASIC's activity. The one thing that's interesting about Vanguard and that isn't made clear by ASIC's communications is that Vanguard actually dobbed themselves in. They realised that they had made a mistake, that they had included incorrect information in their PDS. So they enlivened breach reporting regimes and made a report to ASIC. ASIC, as a result, carried out an investigation, and that led to an infringement notice. So while I haven't extracted the whole of this article, there is quite a bit that quotes Vanguard and makes it clear that the infringement notice was as a result of, as they said, being a good corporate citizen. ASIC's response to that was, well, that might well be, but you still did the wrong thing. So it's not our job to contextualize that in information that we release in our media releases. So it is, when I say that adverse publicity comes in a number of different formats, you need to remember that the media release is not necessarily going to be indicative of the entirety of the circumstances. So moving along, Future Super Fund. Now, I've thrown this in as an example of the breadth of greenwashing obligations. This was a statement on a Facebook page that was there for about 15 months. And effectively what it portrayed, according to ASIC, was that they had moved $400 million in FUM from the fossil fuels sector out of that sector. Unfortunately, that was the entirety of Future Super's FUM. And so ASIC said, well, you didn't have a reasonable basis to assert that you'd moved the entirety out. And so there was an infringement notice that was issued. And I think the fine is really indicative of the fact that it was, possibly conduct on the lower end of the scale. So we move over to the next, which is ASIC and Mercer, the civil proceedings. And these are the first civil proceedings that ASIC has instituted. And it concerns claims as Mercer made in a product that said it would investments would exclude companies involved in carbon-intensive fossil fuels or alcohol producers and gambling companies. ASIC alleges that despite stating that in the PDS, in fact, Mercer invested in the likes of BHP and Whitehaven Coal, Crown Resorts, Tabcorp, etc. So if we move over to the next slide, it is a little bit hard to get information around present court proceedings because of some changes in the federal court rules, but I think that I've tracked down the PDS in question, and you can see, I'll leave you to look at it later on, but you can see there are some pretty clear statements there that around the limitations as to what Mercer will invest in. So remains to be seen how those proceedings pan out. Just quickly, if we move over to the next slide, I wanted to talk about the ACCC activity. They did a sweep in October last year, designed to look at claims made by various sectors with a view to providing industry guidance. So on the next slide, we've got a summary of the themes that, or the key issues that they identified. And it's things like vague and unqualified claims, lack of proper or substantiating information, using absolutes, or exaggerating the benefits. And the last one, which will be sad for all our marketing teams, using images which are intended to convey environmental messages, but they're not actually associated with the certification scheme. So it seems like the ACCC is embargoing the colour green and the use of leaves or the planet. So we move over to the last slide. And this is some tips and traps. And a lot of these come out of that info sheet 271 that I mentioned. So it's really good reading. I think the tip that I would give firstly is don't be really narrow in your consideration of what is a communication. So anytime that you talk to an investor, anytime you communicate with a potential or prospective investor, you need to watch what you're saying in terms of greenwashing. The last point, avoiding green hushing, well, this is a concept of I'm too scared to say anything because the regulator might pursue me. And that came out of a Swiss survey that I spoke about in the beginning, which caused quite a dialogue. The the consensus seems to be that green hushing is just another way of greenwashing, because what it does is allows companies to take the higher ground and say, well, we've got this awesome policy, but we can't tell you anything about it because the regulator is preventing us from doing that. So it sort of creates a bit of a halo effect without telling anyone what the policy actually is. The use of specific language rather than general or vague statements is always really important. Using appropriate comparisons, and lastly, proactively dealing with issues if you detect them. So despite Vanguard's experience, it is still far better to proactively deal with this if you recognise that you have inadvertently engaged in greenwashing, correcting your disclosure, looking at whether you need to make a breach report. So that is the end of my session on greenwashing. I'm now going to hand over to Alexis to give us an update on current tax issues.
Great. Thank you very much, Emma and Selena, for providing such a great update on the legal front. My name is Alexis Kokinos. I'm a tax partner at Pitcher Partners, and I specialise in managed funds. In my session today, I'm going to provide a brief update on some topical tax changes that have recently occurred. But move to the next slide. Mainly just in relation to some clean building changes that are occurring for managed funds, some build to rent tax changes. I'll provide a bit of a state tax update in respect to the Victorian state budget around some of the property changes that are happening, and I'll give a brief update on the public trading trust provisions and what has been happening in the background with some ATO involvement on a couple of issues. So if I move to my first topic, which is the clean building concession. So this first item is a budget announcement in relation to clean building concessions for managed funds. Now, these concessions aren't new and were introduced during the 30 June 2013 income year. So they've been around for around 10 years. Interestingly, in my experience, they are provisions that aren't very commonly used by property managed funds. The provisions only apply to what we call a withholding managed investment trust. So that's a managed investment trust that does need to have Australian assets, does need to be managed in Australia, does need to have the management or the trustee here in Australia. But what they do when you can access these provisions is they provide for a tax or a withholding tax payable on both rental income and capital gains of the fund only being capped at 10% on distributions to non-residents in exchange of information countries, where tax deferred amounts also are subject to no withholding tax. So when you can get access to these provisions, overall, foreign investors can achieve a very low effective tax rate on distributions, which can be something less than 10% over the term of the fund when you take into account tax deferred distributions that aren't subject to withholding tax. So it is a very substantial concessional tax regime for non-residents to invest into Australian property. Before the announcement of the amendments, clean buildings were limited to office buildings, shopping centre REITs, and hotels which offer certain types of short-term accommodation. They needed to have a Green Star rating of 5 stars or a National Australian Built Environmental rating of 5.5 stars. Furthermore, the managed fund itself could only derive income from those types of buildings, other than a very small incidental amount from other types of income. Now, the proposed amendments, which I'll take on the next slide, the proposed amendments that were contained in the budget, was to extend the asset class to both data centres and to warehouses. However, what the government are going to do is upgrade the rating system, so it will be a 6-star energy efficient rating to get access to these provisions. Now, the announcements do apply to construction that commenced after 9th of May 2023. Now, they didn't provide much guidance around what that meant in terms of when does construction commence, but the provisions, when they were originally introduced, did contain some rules. And a building was taken, or construction was taken to commence at the time the works on the lowest level, including the basement level of the building, commenced, and wasn't taken to commence merely because you had done preparatory work on the site for construction. So if you take that definition, if they continue with that definition, it means there were projects that were underway at the time of the 9th of May or post 9th of May that may technically qualify for these concessions. Now, you only get the reduced rate of 10% on fund payments that are going to be made after 1 July 2023. But if you are commencing a project now, essentially what we find with new construction projects is the interest expense and depreciation deduction on these types of properties are quite significant, and they do result in tax deferred distributions in the initial years. So this timing about getting the 10% reduced withholding rate probably coincides with a time frame of when taxable distributions are likely to come out of a new project. So if anyone is considering a new building project and you are looking to tap into additional sources of funding, non-resident funding, it's probably worthwhile considering whether your project could be one that's considered to be constructed or started to construct after the 9th of May, and also what the cost would be if it's not otherwise a 6-star energy efficient project, how much it would cost to upgrade it if it would have the advantage of getting access to additional capital into the fund. I'll move to the next slide. So the next item, which is the build to rent concessions that were announced, were also contained in the federal budget. And as you may be aware, in 2020, there were some amendments made to the tax legislation where if a managed fund did hold housing property and derive rent from housing property, that was classed as what we call non-concessional managed investment trust income. So it's currently subject to a 30% withholding tax rate. There's only some small exceptions in there for affordable housing projects as defined in that legislation. Now, the budget has proposed changes to take effect from 9th of May, again, 2023, and they're looking to provide 2 concessions to any entity, which can include a fund. The first concession is basically a change in depreciation rate for capital works. That's going from 2.5% to 4%. The second is only applicable to managed investment schemes, and that's a reduction in the withholding rate from that 30% rate, which currently exists, down to a 15% tax rate for exchange of information country distributions. Now, they have put quite onerous requirements in the budget announcement. We haven't seen any legislation on this yet. The proposed requirements are that there must be one single owner of the property for at least 10 years. The project must have at least 50 APUMs or 50 single dwellings available for rent, and leases have to be no less than 3 years on each lease. And they're also going to consult on how much of a proportion needs to be on affordable housing. Now, in my personal view, while some of these concessions have been provided, and obviously would always welcome concessions in this space, we believe these measures are inadequate for the managed fund industry and would probably unlikely entice a significant uptake in the managed fund space. Now, if the government was really serious about this measure and wished to tap into funding from managed funds, we believe they should consider more appropriate targeted measures. And we'll be making submissions on many of those aspects. And just to maybe highlight a couple of those key things that we would like to put forward. And again, if anyone in the audience is interested in this space, more than happy to receive feedback after this session on any of their suggestions. But some of the things that we do think are really relevant is the 10-year period. Obviously, that is a long period for investors to invest into a fund and lock themselves into in terms of the uncertainty in the period of investment. So we would like to have a shorter period in terms of life of fund and certainty to investors in the managed fund space. As a fund would have both rental and embedded development profit. If we do get a smaller period, then obviously that increases the risk of having public trading trust provisions applying and losing the deemed capital account treatment on disposal of assets. So we'd like to suggest that those things should be deemed to be satisfied if you have one of these types of funds, so we don't get the unfortunate tax consequences that flow. For example, if you had a fund of 5 years and the PTT or public trading trust provisions apply, you lose a capital account treatment, which means you tax the company, you lose discount capital gains, and all tax deferred distributions come out as unfranked, fully taxable distributions. So again, that wouldn't really work in a fund context. And then lastly, we don't quite understand why the government's willing to give 15% tax concessions to non-residents while only giving a 1.5% increase in depreciation rate for residents, which effectively reverses on a sale of the asset. In our view, it doesn't make much sense in terms of trying to entice domestic capital into this area. So we will be submitting that they should deem these things to be discount capital gains when we sell. That only provides a 5% tax break for super funds. So still not substantial, still not even competitive as compared to what they're providing for non-residents. But we just think that would be a fair and reasonable outcome for investors coming into these type of projects. So if we think that the government are very serious in the BTR space, then hopefully they will consider these alternative propositions when they go to consult on these measures. And again, I'm very open to hearing any suggestions that participants have in this space. So I'll move on to the next slide. And I thought it'd be also important to provide an update on some of the indirect tax issues that came out of the budget that may impact on funds. And I know some of the things that I am talking today about are very property centric, because there's been a lot of changes that I think are very much influencing a lot of the property funds, or will have an impact on property funds. In the Victorian space, there's been three things I want to talk about. The first is the SRO came out with their draft ruling last year in October 2022, DAO 65, providing view on the economic entitlement provisions. Now, these provisions have been around since June 2019, so they're not new provisions, but they've always been anticipated to be very broad in terms of when they could apply. So broadly, amount calculated with reference to the value, gross proceeds, rent, income, profit, or capital growth in land can constitute an economic entitlement. And thus, if you create one of these entitlements, it can be subject to duty in Victoria. This could potentially cover performance fees of a fund manager when you calculate the IR and the performance of a land asset. The management fees, which could be calculated on the gross value of land assets, and acquisition and disposal fees calculated on the value of land assets. So there's a lot of fees that a fund manager or trustee may generate that are connected with the value of land and could very much fall into this. And that's what the DA does cover. There's also debt funds that provide loans to a lot of these types of other property entities. And the SRI do provide an exception when you set interest rates at a commercial rate, even if they are linked to a waterfall and gross proceeds. What it does raise is uncertainty when you're providing loans, unsecured loans at rates that may not be commercial comparable to market in the eyes of the SRO. So they're higher than normal rate, and then they're subject to a waterfall, which is calculated with respect to the gross proceeds from the sale of land. So in those cases, debt funds may find they could be at risk in respect of the loan funding they are providing to property funds under these provisions. The draft rule also covers a range where there's one or more classes of units issued, and the class may be less than 20% in terms of the total fund. So it falls out of the landholder duty provisions, but provides for variable or preferred returns to that class. And the SRO outlined they believe those instruments can be caught by the economic entitlement provision and subject to duty, even if they're outside of the landholder duty provision. So that is a key watch out in terms of those types of instruments being issued. While the ruling's only draft, the key message that comes out of the ruling, the fund managers really need to be aware of these provisions and need to ensure that their arrangements are benchmarked. They should be similar to arrangements with third parties, and they shouldn't be excessive having regard to the marketplace. So excessive rates, obviously, interest rates, fees, etc., as compared to market, are going to have more risk. Considering fixed fee arrangements that are commercially justified probably may also reduce risk around these provisions. The risk is quite substantial if the SRO goes to apply the ease. They can, under certain circumstances, assess it at 100%, multiply by the duty rate on the value of land. And so it can be quite a significant cost to the fund manager or trustee in respect to those provisions. In practice, we're not finding that the EE provisions are collecting a lot of revenue. Instead, they're probably creating a lot of uncertainty and limitations for establishing commercial funds in Victoria as compared to other states. And we're yet to see other states follow, but other states may follow down this path in the future. These provisions do really require careful consideration of structure beforehand, ensure that you don't trip up on the provisions. And again, I think it's in the interest of fund managers to start considering whether they take their arrangements to the SRO to get sign off on their arrangements and on their benchmarked rates on their funds. So I'll keep on this. So I'll move to the next slide where I'm going to just touch on the next item, which is basically in the Victorian state budget, they announced, sorry, I might jump back one slide. Yeah, the COVID debt levy land tax changes. So I just want to quickly just highlight that there have been changes announced in respect to land tax in Victoria, which is going to be assessed in respect to the 2024 financial year, but obviously assessments will come out at the end of this year. They're increasing the rates for holding property. Essentially, those rates are stipulated on the slide in front of you. There's going to be a fixed rate increase and a 0.1% increase for properties over and above 300,000 or 250,000 for trust taxpayers. Now, if you do a simple calculation, you have a $3 million property in a fund, it's probably going to equate to about $3,675 annually you'll pay. $10 million property gets to about $10,675 per property. If you take this up a notch and you have $500 million of assets under management that are property assets, could equate to about $500,000 cost annually if you've got the properties situated in Victoria. That's only supposed to be a 10-year measure, so a short-term debt recovery measure, but who knows if they will remove this in 10 years. So it's something to be aware of. Obviously won't come in now, but next year could add to costs of running the property funds. I'll move to the next slide. And just something again to be aware of, there've been in the Victorian budget, there were some announcements to transfer duty changes. So Victoria is transitioning to an annual property tax for commercial industrial properties. And this is going to apply to purchases after 1 July 2024. Under the new method, you'll have a choice to pay duty on a property upfront or over 10 installments with interest. And once that property, you've paid that duty, after 10 years, it's going to be subject to an annual property tax of another 1%. Once a property is in the regime and it's gone through that transitional, it'll be then subject to that property tax of 1%. So the choice may provide, when you're acquiring properties, a reduced cost to establish a fund, acquiring properties, you might not have to pay the duty up front, but obviously you'll have to pay it over the period of the fund, and it may become an ongoing cost that you'll just need to take into account in terms of rental returns that will need to be used to pay these amounts off. We don't think it's going to have a huge impact on the fund industry in the short term, but it's just something to keep in mind for feasibility studies and other things if you are looking at projects that are going to span into the 2024-2025 income year. Finally, I'll just go to my last topic, which is an update on Division 6C. So Division 6C, for those that are aware, are the public trading trust provisions, and they were introduced in 1986, so they've been there for a long time. And essentially, these provisions can apply if you have a managed fund and it's a public trust. And that includes basically a trust with members of greater than 50, listed funds, or ones that provide IMs to investors. Now, what these provisions do is they limit activities of the fund. Basically, there's a short list of passive activities. And if you fail to comply with only investing in those activities, your fund can then be taxed as a company. The consequence of that is that you can distribute tax-deferred distributions as unfranked distributions, so fully taxable, and you lose the capital gain discount. We're aware that the AHL are currently working on a couple of private rulings. They're dealing with issues such as crypto and carbon offsets. And we understand the AHL are likely to conclude that both activities are not going to satisfy the eligible investment business provisions, and that those funds would be subject to corporate taxation. And it's pretty clear from dealing with the ATO that they are taking a very strict approach in reading these provisions. So if you are taking issue to them, they will give you the answer, and that these provisions are pretty archaic and don't suitably deal with what we'd say is our new type of financial arrangements. Now, one would expect that trading in crypto or carbon credits should be seen as a financial arrangement capable of being eligible. However, unfortunately, they're not being read that way. Now, the provisions do have a 2% of gross revenue safe harbour for these types of income streams, but you really need to be careful in investing in non-traditional investment classes, as it might give rise to significant tax risk and may result in your tax section in your IM being materially misstated, where you might need to update that to investors. So it is absolutely something you need to be mindful of and very, very careful. If you're in doubt, obviously seek advice in respect of it, or seek a ruling from the AHL as our advice around that. Now that brings me to a conclusion of my tax update. Thanks for listening, and I'll pass back to Selena for question time.
Thanks, Alex. So we have a few minutes left, and that means we've got a couple of minutes to answer questions. So if anyone hasn't submitted a question yet but has something that they'd like to ask of myself, Alexis, or Emma, please use the Q&A function. But in the meantime, Emma, there's a question for you, which is, and I hope I'm interpreting this question correctly. So if it's yours and I don't get it right, feel free to submit another question. But if a wholesale fund operator issues interest to retail clients under the 2012-2 rule, do they need to have a TMD?
Yeah, that's actually a really good question. Thanks. for asking that one. So whilst throughout my presentation, we did talk about if you're issuing interest in a managed investment scheme to retail investors, you do need to provide a TMD. The actual test in the Act is that you don't need to give a TMD if you are exempt from providing a PDS. And so that 2012-2 rule, which is the rule that says that you can issue interest to no more than 20 retail investors for a total of $2 million on a rolling 12-month period, is actually an exemption to providing a PDS. So therefore, you don't need to provide a TMD. And just to expand on that a little bit, whilst you don't need a PDS and you don't need a TMD, we would advise that you should look into whether or not you are exempt from the requirement to hold an AFS license to allow you to provide those services to retail clients, because you would still be providing advice and issuing interests. But I'm happy to discuss that further if whoever asked the question would like to contact me.
Alexis, I had a question for you, if you don't mind, arising out of what you were talking about with the transfer duty reforms. That, as I understand it at the moment, is limited to Victoria, but it seems to me that it's something that comes up for discussion around various states. Is there any suggestion at the moment that it's going to be extended?
Yeah, so interesting question. And interestingly enough, we did go through around the 2000s a uniform review of all the state taxes, and they were broadly brought into line with each other. And since then, a number of the states have moved away from that. We did see New South Wales did bring into account a slightly different regime, but with a similar type of effect, which I think is being potentially unwound by the New South Wales government. So it's quite interesting that we do have the current Labor government here in Victoria looking to introduce these provisions, which is different to what's happening in New South Wales on very similar provisions. So it's perhaps going to be different in any state. It is quite an interesting regime in terms of what they will collect in tax over the life of holding assets. So it'll be yet to be seen whether other states are going to look at that as being a potential source of revenue going forward, and whether that will be something that they'll all change to. But the fact that New South Wales itself is going the opposite way with a similar government is quite interesting from our view, yes.
Yeah. Okay, we have another tax question for you, Alexis. If a wholesale unregistered trust buys and sells securities during any year and makes a profit, must it distribute that profit each year? The point is the trust must distribute. Is there any way a trust can decide not to distribute trading profits?
Yeah, sure. No, that's a really good question. So this might depend on whether the trust is what we call an AMIT or not an AMIT. So an AMIT is an attribution managed investment trust, and there's a number of requirements that you need to satisfy to get into that regime. But if you satisfy that regime, then there's no requirement to make distributions from a tax perspective. So you can accumulate all your income. It still will attribute the tax payable to the investors, but they won't receive distributions unless you decide to make distributions. So it'd be completely optional if you're in that regime. If you're not in the AMIT regime, unfortunately, you need to distribute income to investors in order for the tax to flow out of the fund to the investors. Now, income is a very fluid concept, so it can be defined as many different things. You can define it as taxable income. You can define it as a quantum of amount. You can define it as cash available for distribution. You can define it as pretty much nearly anything under a trustee. So it is defined as what is distributable income. You need to have regard to the trustee, but it is possible to manage the amount of a distribution that is made if you are in line with what your trustee otherwise does. But it's very important if you're one of those type of trusts, you do need to get income and 100% of the income out of the fund in order to make sure the tax flows out of the fund.
And Alexis, there's a comment. Thank you for answering that.
No problem. Thank you.
Now, I'm very conscious that it's 1:29 and we promised you all a 1:30 finish, so we might wrap up now. So on behalf of the Melbourne and Sydney Compliance Committee groups, McMahon Clark and Pitcher Partners, I'd like to thank you for the opportunity to present this forum. I'd also like to thank my co-presenters, Emma Donoghue from McMahon Clark and Alexis Kopanos from Pitcher Partners. Just a reminder that links to the slides and the recording will be distributed in the next few days. For more information about anything we discussed today, please feel free to reach out to any of the presenters. Our contact information will be available in the post-webinar email, and you can stalk us all online in any case. Again, thank you for joining us today. I hope you found it as beneficial as I did.